Okay. Until last week, we were discussing capital budgeting, and the topic we concentrated on was cash flow estimation, how to compute cash flows. If you have very poor quality estimates of future cash flows, net present value or internal rate of return or other capital budgeting measures will be poor. Quality of those NPVs and IRs will not be high. And if you have poor quality NPV or poor quality IRR, then your capital budgeting decision will be poor quality. And your decision may not be a good decision, may not be consistent with share value maximization. So you have to have good computation of cash flows, and that's very critical. If you put garbage in, only garbage will come out. Okay? It's called garbage in, garbage out principle. Okay? So try to put in good quality input, you will have good quality output. And in our discussion, we have identified some guidelines and principles of cash flow computation. Number one, every cash flow needs to be computed on an incremental basis. Incremental. It is because of or it is due to the acceptance of the project. Okay? It is incremental to the value of the firm. It is incremental. It is incremental. You don't have to worry about the entire company. You only worry about the cash flows that are the result of the acceptance of the project. Okay? So that's called incremental principle or incremental basis. Another important guideline was sunk cost, related to sunk cost. What do you do with sunk cost? Forget sunk cost. Sunk cost needs to be forgotten. Okay, sunk cost, forget sunk cost. How about opportunity cost? Opportunity cost. Include or consider opportunity cost as part of the cash flows. How about costs associated with cannibalization? Should you include it or exclude it? Well, we said that it depends. It really depends. If it is truly due to the acceptance of the project, yes, you should include it. But if that cannibalization effect is not necessarily due to the acceptance of the project, it was going to happen anyway, then you should not include it as part of the cost. Okay, those are the three important the guidelines or principles of cash flow computation. Today, we are going to talk about how to do it. Actually, how to compute cash flows using a simple example of replacement decision. Now, suppose you have an original machine which has 10-year lifespan, and it has used it for 5 years. So 5 years ago, the company bought this machine by paying $100,000, and it has 10-year lifespan, and it was depreciating it. The company was depreciating this machine each year, $9,000 of depreciation for each year. And after 10 years, the remaining book value will be $10,000 because total of $90,000 will be depreciated away. It was purchased 5 years ago, so remaining book value is a net of accumulated depreciation of $45,000. Therefore, book value is $55,000. And salvage value today, if you should sell this machine today, you can get it at $65,000 in the marketplace. If you do not sell, but keep it for another 5 years, the market value of the machine in the market will be $10,000. Okay, this is the cash flows associated with the original machine. Now, if you should replace the machine with a new one, initial cost is $150,000. And it has only 5-year life. And straight line depreciation will be applied. Therefore, 1/5 of the initial cost will be depreciated each year of $30,000. And salvage value in 5 years. In 5 years, the company sell this machine back in the market, it will get $17,000. Even though the book value, remaining book value at year 5 will be 0, because it will be, by then, depreciated away entirely. Cost saving with the new machine. With the new machine, you can save cost by annually $50,000 a year. Required return is 10%, tax rate is 40%, and the old machine will be sold when the new machine is purchased. The incremental cash flows are the changes from the old to the new situation. Okay, this is the setting. Are you with me with the setting? Okay, this is clear. I gave it as a homework to you, so you should be familiar with it. Okay. Remember that we are interested in incremental cash flows, not the entire cash flows, incremental due to the acceptance of the project. If we buy the new machine, then we'll have to sell the old machine. What are the cash flow consequences of selling the old machine today instead of in 5 years? That's the question that we are asking, and that's the capital budgeting decision. So about the initial cost at time 0. Today, your decision is buy a new machine and sell the old one. Okay? Or do not buy and use the old one. So 2 alternatives. So if we think about buy the new one and sell the old one, how does it change the cash flows on an incremental basis? So buy new machine. Machine cost will be $150,000. That's the cost of the machine. You have to pay $150,000. You can sell the old machine, and old machine is by selling it you get $65,000. But the machine's market value is $65,000, but book value of the machine is $55,000. So the book says that the value of this machine is $55,000, but you can get it by selling it in the market $65,000. So you get $10,000 profit, so-called capital gains income. And this capital gains income will have to be taxed. And wherever there is profit, they will be taxed. Tax authority is so precise, and they come and they charge you tax. So 40% of that will be paid as tax. So that's the tax consequence. So look at this. That's the salvage value in the market. That's the book value in the market. Book value, and the difference, $10,000. That capital gain will be taxed at 40%. Therefore, actual cash inflow by selling this machine in the market, you get $65,000, but you'll have to pay tax of $4,000. Therefore, net cash inflow will be $61,000. Therefore, net capital spending will be $150,000 minus $61,000, and that will be outflow of $89,000. Okay, it's like when you buy a new car and sell your old car. You bring your old car to the car dealer and give the car dealer your old car, and dealer is going to lower the price of the car for the old one. Okay. Okay. I forgot to change the color of these items. Let's start with depreciation. Depreciation. New machine depreciation annually will be $30,000. Old machine depreciation is $9,000. So incremental depreciation is $21,000. That's the incremental amount of depreciation. And that is subtracted from incremental cash flow in terms of cost saving. By having the new machine, you can save $50,000. That's the profit. You lower the expense by $50,000. So your profit of $50,000 will occur subtract this incremental depreciation, you will have incremental EBIT. And for this EBIT, you pay tax of 40%. Then you have net income after tax. And add back depreciation, because depreciation is non-cash expense. And then you have operating cash flow. Operating cash flow is this depreciation plus net income after tax of $38,400. That's the cash flow incremental due to the project. Okay. Salvage value at the end of year 10. The new machine salvage value will be $17,000, and its book value is 0. So $17,000 will be the total capital gains income, and 40% of that will be tax. So net salvage value will be $10,200. But the next line is very important. By buying this new machine, you have you don't have old machine anymore. If you did not have the project, in other words, if you did not replace the project, the old machine will be sold at year 10. But because the project is accepted, in other words, replacement is being made, old machine no longer provides you with the salvage value at year 10. This is the opportunity cost. The cash flow that would have occurred cannot occur because of the project. And this is opportunity cost. And opportunity cost in terms of the net salvage value on old machine. And the old machine will have $10,000 of the remaining book value, and it will be sold at $10,000, so there is no tax consequence. So $10,000 of market value will be the net salvage value, and that amount is opportunity cost. Even though you do not spend that money, that amount of money is to be subtracted from net salvage value on the new machine. This is an opportunity cost because we no longer receive this at year 5. Okay. So terminal cash flow will be the difference between the two of 200. So this is the entire picture. Net cash flow, net of the sale of the machine. Operating cash flow, that's in terms of saving of the cost. And salvage value at year 10. There's no change in net working capital. And therefore, you have cash flow stream, and this cash flow stream will be discounted. All right, this one is not important. And this one is another way of look at the incremental cash flows. Okay, that's about it. And this is the methods of computing OCF. I have so far emphasized only this one. Operating cash flow is EBIT minus 1 minus tax rate plus depreciation. But the same can be done by computing net sales minus total cash costs minus taxes. It will give you operating cash flows. Or I think I wrote it down the other day. Sales minus cash costs and 1 minus tax plus depreciation times tax shield. This is a tax shield approach. Any of the three methods can be used to find operating cash flows. In the exam, I was thinking of not giving these formulas, but I changed my mind. I will give these formulas in the formula sheet. Okay, never mind, never mind, never mind. Okay, one final topic in capital budgeting. I'm not going to, I will not have enough time to finish up the entire discussion about projects with unequal lives. when you have more than one, in other words, when you have two or more mutually exclusive projects, competing projects, you will have to make a choice. And in our discussion so far, we assume that all the competing projects have equal lives. They have 5-year life, they have 10-year life, but all of them have the same lifespan. But in actual case, it's not necessarily the case. Some are only for two years, some are for 4 years, some are for 10 years, some are for even longer than 30 years. So projects, a lifespan will be very, very much different. Now, when you have to consider ranking of any two projects which have different lifespan, then can you apply the net present value rule or internal rate of return rule as usual? And the answer is not necessarily. And we'll see this using an example. Here's project S and project L. S denotes for short-term, short-lived project, and L is for long-lived project. Short-life project, initial cash outflow will be 100, and for the next 2 years, you will get 60 each. Long-life project, initial cash flow will be 100, and it's long life and its cash flows are smaller. But if you compute the net present value using 10% discount rate, long life project has higher net present value than the shorter one. And should you make a decision based on this net present value, if that's the case, you should choose project L. But is it a reasonable and accurate decision? And the answer is not necessarily, because project S is serving to the company for 2 years, and what about the other 2 years, next 2 years? What about the services that can be contributed from project S? In other words, we can replicate, we can repeat this project S again at year 2 to find cash flows for the next period. Like this, project S, first 2 years, you can come this way, and at year 2, replace this machine with a new machine and let it go through for 2 years. That way, we can have project S and project L have equal, common lifespan, and you can compare. You can compare apples with apples. Okay? In the previous example, it's comparing apples and oranges. Now you are comparing apples with apples. If you use this cash flow with replacement chain approach, then the present value of S will be higher than the present value of L. Therefore, S is better. Is there any easy way to do this instead of finding these replication cash flows all the way to have common lifespan? And the answer is yes, there is a way, and it's called equivalent annual annuity approach. Equivalent annual annuity approach. And if I talk about this, I need another 15 minutes, and I don't have 15 minutes. So what I'm going to do is, this is part of the final exam coverage, but it's your responsibility to learn from your textbook. Your textbook has a good description about it, and my note has description on that too. So look at my note and look at the relevant pages of your chapter and study this. This equivalent annual annuity or equivalent annual cost approach. This is a very important one, and I want you to learn it yourself. Okay, having said that, we are done with capital budgeting, capital investment decisions, and we'll be able to go into returns, risk and returns. On Wednesday, I'll talk about returns, historical record, average returns, variability of returns, and more about average returns. And we are not going to talk about capital market efficiency. And that's chapter 12. And I will talk about chapter 13, a little bit about chapter 13, so that you can do your project homework but for the following week as well. Okay, that's all for today, and I will see you on Wednesday.